Happy lunchtime, everybody. It is April 1st, and the stock market is up 17 zillion% in the last 14 minutes. Yeah, April Fools. But are we in a stock market bubble? Very important question, because we have lots and lots of headlines that say that we are. First off, Principled Perspectives from Ray Dalio. You know, I don't always agree with him. Mr. Cash is trash 2 years ago when Kirky Doo said, put some cash in your portfolio for a little while. I think that this is great stuff here, though, for you to get education. So hit the subscribe button on LinkedIn if you have LinkedIn. I will say LinkedIn, I get so many contacts that just want to sell me something. Usually, you know, marketing services, which clearly I need, but I'm too lazy and cheap to bother with. I just write my articles and whoever comes. But yeah, LinkedIn has some great subscriptions for free, and I think you should take advantage of them. Here we are. Are we in a stock market bubble? What does Ray say? Ray says no. What does he mean? He has his own proprietary U.S. equity market bubble gauge, and it says not quite there yet. When we're at the line, we're at the Bubblicious area. So you can see the .com, Bubblicious. You can see 2020. And remember, I said that we were in a bubble at the end of 2019, started 2020, and then COVID hit. And when the crash happened, everybody blamed it on COVID. But as you can see right here, we were lined up for a big correction anyway in 2020 because of the Trumpalicious stuff that had gone on for a few years. We'll see if people can think that all the way through, or if they just want to grab what's easiest and say, well, that crash was COVID. It was a lot COVID, but it was probably going to happen anyway. Here's the financial crisis. We didn't even make it to Bubblicious that time. And you remember that gum, right? Bubblicious? I don't think it's out there anymore. Maybe it is. I haven't had it in years. But Bubblicious didn't even get there during the financial crisis. We collapsed, had a credit collapse before we could get super bubbly. And then we had this long rebound. Lots of quantitative easing in here. Now, massive quantitative easing at the bottom of the COVID crash. And really, I think this crash could have gotten way down here had it not been for the Federal Reserve and the federal government bailing us out. So anybody who wants to say that, oh, the Fed printed too much money and the government did too much, yeah, maybe, but did you want to risk having a depression? Not me. Would rather not even take that risk. That is a tenet of my poker game. Try not to even take the risk if you don't have to, right? I don't win poker tournaments because I just throw the chips in there and gamble. I don't make money in investments because I just throw the money in there and gamble. I don't believe that you need more risk to make more reward. I think you need less risk to make more reward, and I've proved it on the poker tables, and I've proved it in the stock market. I think I'm proving it in life, with the very exception of my diet for a long time, being on sausage, cheese, and beer, just to see how much of it I could have. Now, I've backed off of that. I have apples and bananas and asparagus and Brussels sprouts this week. However, risk is not the pathway to reward. I just want to remind you, having a margin of safety in your investments is the way to approach things, says Benjamin Graham, says Warren Buffett, says Seth Klarman, says George Soros, says, you know, pick your billionaire investor. They don't just roll the dice. Now, some of the entrepreneurs roll the dice and they discover, you know, everybody needs an operating system on their computer, or that early adoption of EVs can make you super wealthy, even if you're going to go through years of choppiness afterwards. Now, I think that we're not in a bubble, but you can see that it maybe could get there. So right now, if you take a look at the Great Depression bubble or the 1990s into the .com crash bubble, we're not quite there yet. Not super bubbly anyway, but there is a threat. So I wrote an article, and this will be on the Seeking Alpha free side, but you get it first. So on the free side of Seeking Alpha, this article is titled, The Stock Market is Not in a Bubble, No Foolin', right? Because it's April Fool's Day. I just titled it, Ain't No Bubble Yet, because that's how we talk in Wisconsin. Ain't no bubble yet. I think we get there. I think maybe. I actually think that some of it has to do with the election this fall, which I wouldn't normally think that. Usually I don't think the elections matter all that much, but I do think this one matters. If Uncle Joe wins, I think we we take some nicks and bruises, but we get through it because there are some demographic things coming down the road that we're going to have to deal with. If Lil Donald wins, I do think that it sets up the biggest big short in history. And those of you who stick with me, I think will make lots and lots of money betting against the stock market, say 2026, 7, 8. Now, could be off at this point. We'll play it in real time. But I do think that is the dichotomy that is setting up. Either we muscle our way through it with Biden, or we just get destroyed with Trump. And then in the 2030s, we come back either way because it's still America. All right. Now, if you read this already, great. If you haven't, I will point out that there are an awful lot of people who've been calling for the everything bubble to pop for a long time, since about 2017 is where I saw that term first. And there was a guy, I forget his name, but his Twitter handle was like the bubble. And I don't really think that he was ever real smart about things. He just talked about a bubble for like 7 or 8 years before the financial crisis. You know, he was 7 or 8 years early. He missed being able to quadruple his money going into the financial crisis. And he did not know how to short the market going into the financial crisis. So what good did it do? And he wasn't managing money like I was. I made a positive 12% return in 2008. Then I was up 90% in 2009. How'd that happen? It's because I saw it coming. In January of 2008, I told people the Bear Stearns collapses were the tip of the iceberg and that it was going to get rough. So I shorted banks and I bought U.S. Treasuries in 2008. That simple asset allocation move was great. In fact, shorting the banks made me money, but it wasn't a big bet. My big bet was on U.S. Treasuries, which went up about 20%. And I think that is the potential trade that we can make at some point if you want to be long only, right? If you don't want to mess around with short investments that could go against you and hurt you. If you just want something that can go up or chop sideways, right? That's not a bad thing. You know, kind of play it like a shell game. 2 of the shells are you break even, and 1 of the shell, we haven't done this example in a while. And 1 of the shells is that you win, right? If it's break even, and win, you can play that game because you can't lose, and you might win. If you win, it's because everybody else is losing, but, you know, you have to take care of you. So I do think that my bet for recession protection will be TLT at some point, but not now. If TLT gets down into the 80s again, I guess at least in retiree portfolios, I will have to own some, and in 401k plan, because at that point, having the recession insurance probably makes sense. I can see TLT chopping for about a year or 2, though. We'll see. A lot depends on the fall. A lot depends on the Fed in the next couple meetings. Now, this everything bubble, right? Because they say it's a bubble. And you know that I hold Jeremy Grantham in great reverence. But when you do a search for everything bubble headlines, and 4,400 results, and it was specifically that search, if you just put everything bubble, it comes up to 1 million. I just want headline. And you go through it, and it's everything bubble and biggest 2024 will be biggest crash of our lifetime, and blah, 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 blah. And which one do I like? The Fed pricked the everything bubble. This is from June of 2022. Remember at the end of 2021, I told you to sell almost everything. I said that we had pushed ourselves back to the edge of a bubble again and that it had to deflate, and that the Federal Reserve was telling you out loud for 3 meetings in a row, hey, we're going to raise interest rates and do quantitative tightening, and you might feel some pain. And I wrote those articles, like 7 of them, 8 of them. And every single time in the comments, it was, you're out of your mind, man. The Fed has our back. You can't call it top. I'm just going to stay in forever. And you know what happened? The stock market came down 20-something%. Some parts more than others. Small caps the worst. And other than some of you folks, I don't really have a whole lot of folks that found me on those message boards over at Seeking Alpha or on Twitter, ex-Twitter, that said, oh, you got that one right. But in the last few years, we've done pretty well. We caught some of the rebound rally. We avoided most of the big declines. We scaled in a little bit early on small caps, especially on a half a dozen names. Some of them we dumped, some of them we didn't. Some of them we loaded up on right at the bottom, a Meta, Spire. And so back in June of 2022, the Wall Street Journal pointed out that the Fed pricked the bubble. And I totally agree with that. And I think that we probably get the bubble-licious, but it depends. Again, I think it does depend on who wins the presidency. Because if Joe Biden wins, the Fed probably has the freedom to do what they think is right and try to, normalize things, to kind of rationalize things, to try to smooth things, which they've been doing for the last few years. But if Trump wins, I think the Fed's got a problem, and he's already said he's going to fire Powell, who I doubted at the very front end. I wrote that I wasn't so sure about this, and you know that I've become impressed with him. I'm going to write an article that tells him to lower interest rates a half point and explain it as just taking the last one off. It might not be a new cycle. Hopefully, somebody whispers that in his ear. We already know there's 2 Fed presidents that like that idea. I think it would be good for home ownership. I think it would be just enough to help the banks so that they don't get into big trouble. And I don't think it would be enough to spur inflation, which is like 4th in the list of important things out there. But, people still like to sing about inflation because, hey, 3 times in the last 30 years, we've had inflation over 3%, because those 3 years really have defined our entire existence, haven't it? Right? 3%, 3 times. Oh, it's all about inflation. Nah, man, we're going to be talking about deflation soon, the next few years, by the end of the decade for sure, just like we did in 2008 and 9, just like we started to a few years ago. Get a COVID shock, get OPEC pushing the price of oil up, get China messing with supply chains, you get inflation. But they can't do it for that long. OPEC can keep the price of oil high as long as they want to, but not super high, because then they kill the economy, they sell less oil, right? They're looking for balance. They're trying to be in equilibrium, supply demand lines crossing each other at a price that clears the market. And the oil market has largely been getting cleared for a couple of years. So while we may whine about the price of oil being a little bit high compared to when it was way low, the reality is that supply and demand for oil are basically in balance. That will change as demand falls and panic pumping starts at some point this decade. However, until then, equilibrium. The supply chains, though, with zero COVID policy over in China, and I don't know that they really believed that, but it really messed up supply chains for a couple of years, and that caused inflation. But it also spurred a reshoring of the economy back to the United States, the manufacturing side. We already were dominating on the services side, and now we have semiconductors and all sorts of other things moving back. I see it in Milwaukee. There's a shortage of industrial space here, real estate space. That's one of the other projects that these guys I know downtown are looking at trying to do, build a double warehouse industrial site. So where does that leave us? Well, on the S&P 500 side, it means that we're overvalued, historically speaking, but not as historically overvalued as we've been a couple of times, kind of down in here. If it gets up to here, big trouble, right? Then you're expecting a big correction. Maybe you're going to get one of those XYZ, XY things or whatever those bam, right? So during the financial crisis, we actually, in here, you can't really see it here, but there were 9 waves down in the financial crisis. If Trump wins, I think we get 9 waves down, and I think it takes 2 or 3 years. I don't think it turns into a forever 10-year depression, but I think it ends up being like, those of you who remember 1980 to 1982, it would be something like that. It would set us up for a big rally afterwards, but the pain during those 2 or 3 years, that's the kind of stuff that starts very significant civil strife and crime. I don't use the CW phrase because I think it's bullshit. I don't think that will ever happen, so I talk about it. But there are things to be afraid of. And when we stray from an idea that we're trying to stay in the middle, that we're trying to find equilibrium, we get into trouble. Extremism is bad. Radicalism is bad. Nationalistic populism is bad. Then Hitler exploited it. Then you got World War II. Lots of things that you learn from history. And one of them is that lots of mistakes get made. My fear of Trump is that the mistakes are much more likely to get made and that are much more likely to be big. That's my fear. This isn't ideological. It could be, but it's not. I'm looking at what's good for me and for my grandkids, my kids, my grandkids. I think I'm going to meet great-grandkids eventually, at least at the tail end, right? As I'm rounding third, I might meet a couple of great-grandkids. And you think about 10, 20, 30, 40 years out, and it's hard not to actually think that it'll be pretty good further out, presuming we don't blow it all up. In the shorter run, or burn it all up, in the shorter run, you try to figure out how can I make money for the next year or two and then not lose it in the next time period as I wait for long term that's beautiful. And I think that making money on expanding market breadth, here's those Dalio charts, probably the thing that's going to do it for us. So we have seen market breadth expand since the end of last year. It's not all Magnificent Seven driving the gains. So last year, the Magnificent Seven, just those 7 stocks, were 60% of the gain in the S&P 500. Now it's down to 34%, mainly because Apple and Tesla are negative this year. The other stocks aren't roaring, but they've been drifting up. And ultimately, this could get back up here. We'll watch it. This one isn't popping out for us, but stock concentration risk usually has coincided with recession. But the thing that I'm wondering is this: have we faded a recession, at least in the short run? I think so. I think the next year or two, we do not get a recession. I think we have a recession before the end of the decade or towards the end of the decade. Again, how bad it gets, I think, depends on who's in there in the presidency and the Federal Reserve. I have to play it by ear. You know, I want to own the Brewers, so I have a motivated self-interest. Play it like the Joker and just see everything burn. But on the other hand, I'm a pretty nice guy, so I don't really want that. I'd rather find long-only investments that make me $1 billion. And there's a reality about what's going on that's pretty clear. Indexers, about half of the people investing right now, are indexing, directly indexing. And there's a big hunk of what's left that don't know that they're indexing, but they are, right? Because they buy 7 large cap funds, and really it's just an expensive way of indexing. So that has caused the S&P 500 price earnings ratio to be higher than historical in general. It'll take a long time to whittle that down as other investments do well and people finally switch. The AIAE ratio is suggesting the S&P 500 returns over the next decade end up being low single digits. Kind of like Case-Shiller, kind of like Tobin Q. It's just one of those things that showed a leg. But look at these lines, right? The black line is real time. The blue line follows the black line and is the forecast. So S&P 500 gains are probably going to drop over the next 10 years. Everybody was ripping on Case-Shiller up here as it spiked. As the stock market spiked, everybody said Case-Shiller was wrong. Turns out S&P 500 is in fact about the same place as it was 2.5 years ago now. And Case-Shiller turns out once again to be pretty prescient. So was this one. So was Tobin Q. All different types of ratios of leading indicators that can tell you roughly what's coming. One place where you're not seeing a bubble is in small caps, which have not reached their high, and in fact have just chopped along average. They've raced up a little bit in the past 6 months, 7 months. And the question we have to ask is, does it get up here and retest? I think it does. Doesn't mean you can't fall back a little bit for a hot minute if the dollar gets heavy. But I think we're probably going to retest the highs, and maybe not all the way to the high, maybe this line, or maybe about here. What that means is that if you're a stock picker, you can probably pick out some good stuff, which is what we've been doing. I am not an IWM investor because 2,000 stocks, there's just too many bad ones for me to have a stomach for. But we know that the growth rate on the Russell 2000 is between 6 and 7 percentage points higher than the S&P 500, basically double. And we know the earnings per share growth is higher on the Russell. And we know that the ratios are better. The valuation ratios are better. Now, what do the large caps have an advantage of? One, it's the indexers, but on the fundamental side, it's that they generally have better balance sheet. There's a value in that. But the differential between relative price to earnings ratios is pretty huge right now. And that gap has to close. Whether the valuations on large caps come down a bit more than they do on small caps, or if they both go up, but small caps go up faster. Hard to know how those alligator jaws work, but that ratio will close. And on a relative basis, small caps should outperform large caps for the next year or two. Again, we'll see what happens after that. But Peter Lynch's wisdom, the big companies have small moves, the small companies have big moves with, NVIDIA exceptions, pretty much has held forever. And we can make a lot of money selectively buying small caps. And it doesn't even have to be, over half of your portfolio like it is with me. It can be 10, 20, 30% of your portfolio, but have a real asset allocation that's not 80% large caps that turns you into a closet indexer. Other place, emerging markets are clearly not in a bubble. Been chopping around the highs from 2007. That's 17 years in the same area. This is a big rectangle. We know a couple things. We know that the forward PE of emerging markets is 11.85 right now, give or take, which is almost exactly the historical average. They get discounted because they're emerging markets. The Shiller or cyclically adjusted 10-year PE for emerging markets is about 15 versus 27 for the developed market. Again, alligator jaws. Those have to come closer together, and they will. They might open up again at some point, probably will, almost always do, actually always have, but then they close. Alligator jaws open and close. How they open and close, we can do our best to figure out. Does one go up faster than the other, or does one go down slower than the other? Some combination thereof. And that's what we're looking for. Now, everybody knows the Asia and India stories at this point. I will tell you, I think that Latin America, South America, Central America, Mexico are overlooked. At some point, there will be a year or two where they get a lot of money invested. That'll drive a lot of prices up. We kind of saw it with Stone. I decided just to use ETFs for some of these regions because researching the stocks is very hard. I am building an international stock list, but it's taking time because I don't want to just do what 80% of the other people do, which is, oh, look, that looks pretty good right now. It looks all right, so I'll put it on my list. I'm doing a lot of reading, a lot of research, a lot of AI stuff. So picking out international stocks is hard, but doing the asset allocation by region and sector is a little easier, a little bit more relativism, a little bit more reversion to mean. And we are seeing some interesting things. Argentina, which I've been talking to you about since their election, since right before their election, suddenly they're fixing their balance sheet and they bought Bitcoin. Suddenly Argentina might be ahead of a lot of the world and catching up and getting past and getting over the hump. Now, I will tell you one thing. Venezuela has to be brought to heel. They have to be brought towards an equilibrium with their neighbors. I don't know how that happens. I suspect it's through very shrewd bribery by giving Maduro an exit plan, something that allows him to save face, using Chevron to help them develop their oil resources for the next decade so that they can get back out of poverty. Remember, Argentina and Venezuela used to be rich. They have resources relative to the size of their populations, just like in Brazil, which has more people, but still good resource position relative to their population. None of those countries should be poor. I think Teresa could tell you all sorts of things. She was there for a long time in Peru. I think Latin America is going to do very good in the next generation. And we have an opportunity, especially on any of the dips. I think that this trend is real. I think we get a little dip and you should buy it. I have this fund, ILF, in my 401k plans. And I suspect, you do have to position trade it a little bit, but I do think it breaks out. There is a lot of room for the capital. Think about it in terms of market cap, not share price. But it's pretty easy to see that over a generation, the market capitalization in the whole region should double twice. And I think if we don't blow it all up, double 3 times, 8x. If I told you that you'd have 8 times more money in 15 to 20 years, how would you feel about that? The downside is you only double your money. The most likely thing is that you quadruple. If that were the story, how would you feel about that? You should feel pretty good. That means your downside is a 5 or 6% return. The most likely thing is 10 to 15%. And there's a shot that you average over 20%. How many of you have averaged over 20%? How many of you have averaged close to 15%? I can tell you it feels pretty good over a long period of time. And there might be one of those years where capital flows in, foreign direct investment is huge, and you might almost double your money in 18 months or 2 years. Historically, that's the sort of thing that happens. Look back here, right? This is what I think is coming, starting from somewhere in here. Big ramp up. Very much encourage you to look at Latin America. And I think this is the fund. This is their leadership positions. Can you buy small caps? Can you pick out stocks? You can. That's really hard and requires better management skills and more time investment. I think this is the fund that balances all those things. So what are we thinking? What are the closing thoughts? In the short run, the next year or two, I think the best investments, and we've seen this with the equal weight indexes outperforming the top heavy market cap indexes, is to understand that breadth is expanding until it touches almost everything like it did in 2021 when it hit 95%. There's still expansion. We're at about 80% right now. Last 15% will take a while. When it starts to look like the second half of 2021, then trim, sell. I think that the best opportunities are picking out a basket of small caps. We've talked about that. We have seen how it can play out with a limited number of names. And I think one of those big rallies are coming. Again, you can't overweight it if it keeps you up at night, but you should have something. And then in emerging market, I think you got to have some exposure there. I have both an emerging markets bond fund. That's my broad exposure, because you are seeing institutions load up on emerging markets bonds because they know what I just talked about, which is that emerging market sovereign balance sheets are getting better. Their growth is higher. Interest rates are high and likely to come down. and their currencies are likely to get stronger, in particular because a lot of them are buying Bitcoin. We are seeing what I've been talking about for years now. Back when I said the dollar would be on par with the euro and everybody laughed at me. Can't possibly rise 25% against the euro, and it did in just a few years. Europe is going to be in choppy sideways movement forever as far as you're concerned as an investor. If there's a global recession, which there will be at some point, and everything crashes, you'll hear people talking about investing in Europe, but so what? You'll still do better somewhere else. Demographics are destiny. Vietnam, India, South America, your places that are young, resource rich, adopting technology, which is happening everywhere, faster in some places than others, but it's coming. And you see that they do well. Now, I would give you an analogy right now. Yesterday on Easter, a lot of you had chocolate. And if you notice, the price of chocolate from last year to this year almost doubled. Why is that? It's because the cocoa in West Africa, which a couple of big companies have exploited for decades, that market finally got messed up. People threw up their hands and said, we're just not going to deal with it, not going to grow more of it. So supply and demand got out of balance. For the cocoa market to get back in balance, people who do the work, tend the land, that own the land, own the resources, going to have to be compensated better. Price of chocolate ain't coming back down for a long time, folks. Because like in South America, in Latin America, Central America, people in Africa have been exploited for years, decades, centuries. And we are at an inflection point in history where they say, we're just not going to take it anymore. We love to send you chocolate, send you cocoa, but you're going to fucking pay for it. I shouldn't have to live in a hut so that you can have a chocolate bar. Could I have some fresh water in a house? Maybe a pickup truck to throw those cocoa beans in? That mentality, that psychology, that reality is hitting the world right now. Understand it, respect it, invest based on it. It's not going to change. It is another secular trend. The emerging markets are emerging. At some point, the investment prices will follow. Again, I don't know how fast it happens. It's another thing that I think depends on the election, on the time frame. I think in the long term it happens. It's just a matter of, does it happen sooner or later? So I think you can be long for a little while. I think you have to manage your position trades adeptly. There is no such thing as set it, forget it. If you think that there is, you're wrong, and you'll always be wrong. Position trading, your asset allocation, and your investments is required to outperform the market. And you don't have to trade much. You don't have to trade in whole. I just trimmed a couple stocks today. I sold a little bit of Ford and a little bit of Square. Why? Because they had little rallies. And I can sell puts on Ford easily. And I own a bunch of Bitcoin. So I don't have to have a double position in Square block. So I trimmed them. And if they come down 10 or 20% in the next few months before Powell actually lowers rates, especially if he talks tough in May, like he's been talking tough the last couple days since the last meeting, when he wasn't so tough, right? The guy he's a master at rhetoric, keeping people on their heels, because that's where he wants them. And he wants them to lean into it. He'll say what he needs to say to get them to lean into it. Right now, he wants them on their heels. It's like fishing. When you fish, every now and then you give the fish some line. That's what Powell's doing, man. He's just fishing, a little pull, a little bit of line, little pull, a little bit of line, little pull, a little bit of line. I should have had the video on because I was very amusing right there. If Jolene saw what I did, she'd laugh her ass off because I talk with my hands once in a while. Visualize it. Pull the line, give a line. Pull, give some line, right? Fish ends up in the boat. Last month or two, I've been telling you to sell some covered calls, take in some income. We haven't had a lot of cash secured put sales because I expect a little bit of a breather in this market. And that breather, I think you're going to want to get fully invested. But keep in mind that a year or two out, you have to do some trimming and taking some profit. When you think about taking profits, don't just say, oh, I say it went up, so I should sell something. No, think about each of your positions in market cap, not price. Because then you understand it better. Some of the little companies, they need to go up in market cap 300-500% before it makes sense to sell them. Too hard to make the little trades unless that's your thing, right? If it's your thing to be a little trader, day-to-day trader, week-to-week trader, and you're good at it, and you can do what Shooter does, have at it. But if you're like me, and you don't want to spend that much time doing that, and you're happy waiting for the spikes in both directions, and you trim a little at the tops and you trim a little at the bottoms, and you play the macro just a little bit. And by the way, macro is overrated for investing. It matters, but it doesn't matter so much week to week. It matters more like quarter to quarter, right? The world doesn't change that much week to week, but quarter to quarter and year to year, there's some ebb and flow. So these people that write a macro piece every single week, I read Forest for the Trees because it's a great summary and I got it on the cheap. I would never pay $99 a month for it. Not unless, well, even with what I manage, I don't think I'd pay for it. I would get bear traps before that. If I had to pay a lot of money for something, I like bear traps better. But that's double Forest for the Trees. Forest for the Trees does that summary I like. I get it for $99 a year instead of $99 a month because I was early on. I knew that he was good. I like the format. FS Insight, which is FunStrat. I talked to them briefly about maybe working with them. I just didn't want to live in New York at that point in my life a couple of years ago. In hindsight, I think I missed another opportunity to spend some time in New York, but oh well. I love you guys. I'm happy where I'm at. I love my grandkids. And frankly, I think that living in Milwaukee area is one of the safer places to live in America. So there's that. I'm a risk averse guy, even though I like to buy small cap stocks and invest in emerging markets. I'm looking for ways to do it where the risk is lighter and the upside is asymmetric. And I know that people like to think of, well, I get a dividend of 5% and 5% annual return and make 10% and blah, blah, blah. The thing is, it just doesn't work that way. Over longer periods of time, we know that most stocks round trip and a third of them cut their dividend. Just no set it and forget it. There's not. It's too bad. I wish there was. If there was, that means that we're living in utopia. I'm a positive guy with a nice outlook on the world, right? I think we don't melt it or blow it up. We're in good shape. But there's no set it and forget it. You have to ebb and flow trade. That doesn't mean a lot of trading. It just means, hey, you got to kind of understand what you're doing and why you're doing it. And if you think in the terms of market cap, total addressable market, rather than just looking at green and red numbers on a screen, I promise you that you will invest better. Have a great day. I'm going to get some of this stuff edited this afternoon. Jolene leaves a visitor mother in about 6 hours. So I'm going to spend the rest of the afternoon with her other than editing the 2 webinars, which I might even do tonight. Actually, I probably will do tonight after she's gone. I encourage you. Hopefully a lot of you saw family or talked to family yesterday or friends. Weather's starting to get good. Baseball season just started. Lots of good things out there. Find a way to fight off cognitive dissonance even when the market is red, because the long term is green. Have a great week.